Welcome back to Investing Talk Podcast.
Today we're looking at Robinhood.
As usual, before we start, subscribe, like, and comment to this video to support the show.
You know, usually when we pull up a fintech company, we're looking at, well, pretty dry stuff. Interest rate sensitivity, loan loss provisions.
Right.
But looking at the research for Robinhood's 2025 annual report, it really feels like we're watching a company shed its skin. It's trying so hard to stop being that gamified trading app and turn into a legitimate financial infrastructure play.
Infrastructure play is a heavy label. I mean, I'm looking at the same data, and yeah, I see the record numbers for 2025, but I also see a stock that dropped after earnings because they missed revenue expectations in the fourth quarter. So if they're such a powerhouse, why is the market punishing them? Why the sell-off?
That is the headline reaction, isn't it? The algorithm reads revenue miss and just sells.
Right.
But if we stop there, we miss the actual metamorphosis.
Yeah.
The narrative isn't about one single quarter where crypto volume dried up. It's about a fundamental shift in the business model. We're talking about a record-breaking year where they grew something called other transaction revenue by 300%.
And you're talking about the prediction markets.
I am. And honestly, this might just be the thing that finally decouples them from the roller coaster of, Bitcoin pricing.
Okay, we definitely need to unpack that because prediction markets sounds a lot like gambling to the average regulator. But before we get to the shiny new stuff, let's look at the actual engine room.
The numbers.
Let's look at the actual numbers because numbers don't lie, even if they sometimes disappoint the street.
Fair enough. Let's strip it down to the fundamentals.
Yeah.
So full year 2025, Robinhood hit a record $4.5 billion in revenue.
Okay.
That is up 52% year over year.
52%. For a company that's already this established, that is, well, it's rare. Usually growth slows down as you scale. You expect that from a startup, not a public company this size.
Exactly. But the real story isn't just the top line, it's the efficiency. Adjusted EBITDA, which, for everyone listening, is basically a measure of their core operating cash flow, hit $2.5 billion.
Up 76%?
Up 76%.
Well, hang on a second. Adjusted EBITDA can sometimes be where companies hide their sins, but $2.5 billion, that implies an EBITDA margin of what?
It's sitting at 56%.
Okay, that needs context. A typical grocery store runs on maybe 2 to 4% margins. A good software company aims for 40.
Right.
56% is just absurdly high. It's basically a money printer at that point.
It's a software-level margin on steroids. And that's why I used the word powerhouse earlier. They aren't just growing revenue. They're keeping more than half of every single dollar that comes in the door.
And they're not just spending wildly to get that growth.
No, even if you strip out some one-time tax benefits they had,
Right.
their core profitability still grew about 23% year over year. They've become incredibly lean.
But, and this is where I have to be the skeptic, let's zoom in on Q4 specifically. Because if the annual numbers are so good, why did the stock take a hit? The Q4 revenue was $1.28 billion.
Which, in a vacuum, sounds great. Up 27%?
It does, but it missed the street's expectations. Wall Street wanted more. It feels like the market was priced for perfection, and good just wasn't good enough.
I did want more. But look at where the money came from. Equities trading, regular stock buying was up 54%. Options trading up 41%.
So the core business is fine.
The core business is on fire. The miss came from somewhere else.
Crypto. Yeah, we'll get to that in the risks because that elephant is definitely in the room. But I want to circle back to that hidden gem you teased.
The prediction markets.
You said 300% growth. What exactly are we looking at here? Is this just people betting on the Super Bowl?
It's called other transaction revenue in the report, and it hit $147 million. And the driver is what they call event contracts. So think of these less as sports betting and more like binary options. Will the Fed cut rates? Will this candidate win?
So you're trading on an outcome.
Exactly. And in Q4, they had 8.5 billion contracts traded.
I'm sorry, billion with a B.
8.5 billion.
That is a staggering amount of volume. But why does this matter for the stock? Is it just a fad? I mean, we've seen engagement fads before.
It matters because it solves Robinhood's biggest problem, boredom. When the stock market is flat or crypto is boring, people stop opening the app.
Right.
But there is always something happening in the world to speculate on. It keeps the user engaged. It's a totally different asset class that captures that speculative energy that usually just leaves the platform when stocks go quiet.
So it's basically an engagement hack. It smooths out the lull periods.
Ideally, yes. And looking ahead, their guidance for Q1 2026 is projecting $1.33 billion in revenue, and they're aiming for $5.55 billion for the full year.
So they're telling us the growth isn't stopping.
And that they have a new engine to drive it.
Talk is cheap, though. A trading app is only as good as the money people trust it with. If I'm putting my life savings in there, I want to know they are solvent. What's the moat looking like?
Well, net deposits exceeded $16 billion in the fourth quarter alone.
Okay, I can't really spin that negatively. That's the 8th straight quarter they've seen net deposits over $10 billion.
It is.
That shows a level of sticky behavior from the user base that I think skeptics, myself included, often overlook. People aren't just trading there, they are banking there.
And it's not just passive cash sitting there. It's the subscription model, Robinhood Gold. They just hit 4.2 million subscribers. That revenue is up 56% to $50 million.
See, that is the metric I prefer over trading volume. Trading volume goes up and down with the market mood. But subscription revenue, that's recurring. That creates switching costs.
Exactly.
If I'm paying for gold, I'm less likely to move my money to Schwab just because I feel like I'm losing value. I'm locked in.
It's the Amazon Prime model applied to finance. Once you're in the ecosystem, you stay. And they're widening that moat with innovation. They're rolling out Ethereum Layer 2 innovations.
Hold on. Ethereum Layer 2, we promise not to drown everyone in jargon. Give us the simple version. Why should a stock investor care about Layer 2?
Right. Okay.
Yeah.
Think of the main Ethereum blockchain like a really busy highway. It's expensive because of tolls and traffic.
Okay.
Layer 2 is like building a super fast express lane right on top of it. It's cheaper and faster. By integrating this, Robinhood is letting users move crypto in and out rapidly without paying huge fees.
So it's a defensive wall against the crypto exchanges like Coinbase?
Right, while their 24/7 trading attacks the traditional brokers. It's a pincer move.
Smart. Attacking legacy brokers with hours and crypto brokers with tech. But as we know, fundamental health doesn't always equal stock price. The market has a mind of its own. So let's pivot to the charts. What is the price action actually telling us right now?
It's a bit of a battleground. Following the earnings on February 10th, we saw some serious volatility.
Yeah, the stock was swinging between, a low of around $77 and a high of $88. That's a wide range for just a few days.
It is, and right now it's settling, closing around that $84 to $86 range.
To me, looking at the technicals, this just looks like consolidation. For anyone listening who doesn't stare at charts all day, that's basically when a stock takes a breath after a big move.
Yeah, it's deciding whether to climb the next mountain or roll back down the hill.
It's a waiting room.
It's digesting the news. And you have to remember, the stock had a big run-up before earnings. The psychology here is interesting. The stock fell despite the beat on EPS.
Right. Earnings per share.
It signals the market might be selling the news.
The classic good news is bad news scenario. Great, you made record money. Cool, I'm taking my profits now. So what's the trigger? If I'm a trader, where are my eyes drawn?
You are watching the $88 level.
Mhm.
That is the ceiling right now, or what we call resistance.
Yeah.
If it can push above $88, it implies the sellers are exhausted and we could be going back to renewed highs.
And if it breaks that, the momentum chasers, the algorithms, and the day traders will jump back in.
Precisely. And the volume context supports that potential. We talked about those prediction markets volume there doubled quarter over quarter.
Right.
That suggests strong retail engagement. The users are active. So even if the stock price is going sideways, the engine underneath is revving high. The actual usage doesn't match the stagnant price.
So the car is idling, but the driver has their foot on the gas.
That's the feeling.
Okay, so we have strong fundamentals, messy but potentially coiled technicals. But what is the street saying? Is everyone bullish? Is everyone scared?
It is surprisingly confused.
Confused.
Well, let's look at the quantitative scoring. We track how algorithms read the news. The sentiment scores across the board are flashing neutral.
Neutral, like 0.
Literally 0. The top stories about the earnings beat, the revenue miss, the Layer 2 launch. The algorithms are reading them all and essentially shrugging.
That makes sense, though, doesn't it? It's that tug of war we talked about. You have record annual results pulling one way and a specific Q4 revenue miss pulling the other.
Exactly. The algos don't know whether to cheer or boo, so they do nothing.
A stalemate in the headlines.
But, and this is a big word, the human analysts are taking a stand where the bots won't.
They usually do. Who's stepping out on a limb?
Wolf Research, they're not staying neutral. They upgraded the stock to outperform and slapped a $125 price target on it.
125. We're trading around $84. That's That is significant upside.
That's about a 50% move from here.
Mm-hmm.
So while the news bots are sleeping, the analysts who actually dig into the financial model are seeing deep value. They see that margin expansion we talked about and believe it's durable.
So they're not looking at last quarter's crypto dip, they're looking at next year's profit margin.
Precisely.
What about the smart money, the institutions, the insiders? Usually, if a stock dips on a misunderstanding, you see the CFO buying shares with his own money. Are we seeing that?
Quiet. You aren't seeing specific cluster buying where multiple insiders buy at once, or big institutional accumulation reports recently.
That's usually a caution flag for me. If the value is so deep, why aren't the insiders eating it up? If I ran a company and thought my stock was 50% undervalued, I'd be buying.
True, but look at what management is doing with the company's money. They are laser-focused on share count reduction. They're buying back their own stock.
Which aligns with shareholder interests.
Just as much as an insider buy. They're effectively saying, we think our stock is cheap, so we're going to reduce the supply.
Fair point. But my job is to be the skeptic. I'm the guy who looks for the leak in the boat. So let's look at what could go wrong.
Let's do it.
Let's enter the bear case. Risk number one, and it is a massive one, crypto volatility. We can't gloss over this. In Q4, crypto revenue was down 38% year over year. It dropped to $221 million.
That is a significant hit. No way around it.
And it was driven by a Bitcoin crash. This proves that no matter how many prediction markets they launch or gold subscribers they get, they are still tethered to the wild cycles of crypto. If Bitcoin catches a cold, Robinhood gets pneumonia.
That is a valid concern. They are exposed to that beta, that market risk. But let me offer the rebuttal.
Go.
You mentioned crypto volatility. Yes, it was down. But that is exactly why the prediction markets are so critical. That segment grew 300% in the same quarter. Crypto tanked. It acts as a hedge.
So you see it not just as growth, but as a stabilizer?
Absolutely. When crypto goes quiet, people start trading event contracts on elections or economic data. They are diversifying their revenue stream so that they aren't just a Bitcoin proxy anymore.
Okay, risk number two, the expectations game. We saw it this quarter. They post record numbers, but they miss the Q4 revenue target and the stock gets punished. The market has priced in perfection. Any slip up, any tiny miss, and the trapdoor opens.
It's the curse of being a growth stock. The bar is always moving higher.
Exactly. And if they miss Q1 2026 guidance, that $125 price target just vanishes.
That is the risk. Execution has to be flawless.
And risk number three, macro and AI fears. There's this looming fear that AI is going to disrupt financials, commoditize trading even more, plus just general macro headwinds. If the economy slows, people stop gambling on options.
They hoard cash. Those are all real risks. But on the AI fears, Robinhood is actually incredibly disciplined. They aren't bloating their staff. Expenses are managed tightly. And remember that margin, a 47% safety cushion. If a recession hits, they have a massive buffer that other fintechs just don't have. They can survive a winter that would kill a smaller competitor.
So you're arguing the super app strategy is actually working,
Right.
that the sum of the parts is stronger than the individual risks.
I am. They are building an ecosystem that can weather a storm in one sector because the other sectors are firing. They are not a one-trick pony anymore.
All right, we've looked at the record numbers, the messy charts, the neutral sentiment, and the very real risks. It's time to get off the fence. Let's move to the verdict.
Okay? I've crunched the numbers, looked at the roadmap, and weighed the risks.
Give it to me. What's the score?
I'm giving Robinhood a bullish score of 8 out of 10.
8 out of 10. That's confident, considering the Q4 miss. Walk us through the thesis. Give us the elevator pitch.
Here's the bottom line. Robinhood just delivered a record 2025 with $4.5 billion in revenue and $2.5 billion in EBITDA. They proved they can beat earnings per share even when the crypto market crashes. That's resilience.
And the future.
The roadmap is incredibly strong. They have the Ethereum L2 testnets, they're moving into tokenized assets, and they're expanding globally. They aren't sitting still.
And for the investor listening right now, looking at that $84 price tag.
The value proposition is clear. At roughly $84, this post-dip entry point offers significant upside. If the momentum continues and they hit that $125 target Wolf Research is calling for, you're looking at serious gains.
And what's the time frame? Is this a day trade, a long-term hold?
I'd say it's a swing trade into the Q1 earnings to capture the short-term rebound that moved back to $88 and beyond. But fundamentally, it's a multi-year hold. You're holding for the layer 2 story and the eventual crypto recovery.
So buy for the swing, stay for the revolution.
Couldn't have said it better myself.
Well, there you have it. A record-breaking year masked by a quarterly miss and a new prediction market engine that might just be the rocket fuel for 2026.
It's definitely one to watch.
Subscribe, like, and comment to this video to support the show. We'll see you next time.